Welcome to the Doctor's Eyes Only podcast, brought to you by Vestia Personal Wealth Advisors, where we are on a mission to help the highest caliber physicians achieve wealth that matters.
Hello, everyone. Welcome to another episode of the Doctor's Eyes Only podcast. I am Lauren Oschman, and I'm here once again with my partner, Forrest Friedow, who is joining today for what I think is going to be a very exciting episode. We are going to talk about a concept called advisor alpha. This is a research-backed idea that originated from Vanguard 25 years ago now. So they actually have an updated version of their report on this concept coming out here soon that we are very anxiously awaiting. And this is the idea that the value of a financial advisor extends well beyond investment selection, so much so that you can actually add value to return over time in working with an advisor who can do kind of a multifaceted financial plan for you and who can focus on the behavioral coaching that's needed to help you stick to those long-term plans. So I'm so excited to have one of the authors of the Advisor Alpha research, Michael DiJoseph from Vanguard, here with us today to talk about this powerful concept. Mike is an investment analyst in Vanguard's investment strategy group, Vanguard's global team who's responsible for developing the firm's investment methodology and publishing their proprietary research on a variety of investment, economic, and portfolio management issues. He's written numerous research papers, primarily focusing on retirement, advice, and portfolio strategy. He serves on the retirement and investment behavior working groups and regularly acts as an ambassador for Vanguard, doing things like what he's doing with us here today. Before he joined the investment strategy group, he's supported Vanguard's fixed income portfolio management, that's largely bonds. And he actually, I think, started on the equity desk. So he's been all over all the different functions of investing at Vanguard. And he is also what's called a chartered financial analyst, which is a very prestigious designation in the area of investments. So welcome, Mike. We're so glad to have you here today.
Thank you so much for having me. Really excited to join you guys today.
Same. And Forrest could not resist getting in on this episode. He's been a big fan. He's actually the one that turned me on to the Advisor Alpha research years and years ago. And so very excited to be talking about this. And really, I mean, doctors, it largely are very data driven in how they think about making decisions. They love things that are research backed. And so this idea of being able to quantify the value in return that comes from working with an advisor that can do financial planning is really, really exciting. Maybe before we dive into actually talking about that, could you maybe give us kind of a lay of the land, Mike? Just help us understand kind of how the advisory business has grown up to what it is today. Because a lot of our listeners are in medicine and they might not actually know that.
Sure. I think that's a great place to start. I could talk about that all day, right? I consider myself like an advice industry historian in a sense, but if we kind of look back, I think you go back really not that long, maybe 30 years ago or so, and what we know of today as financial advice was stockbrokers, right? So we've all seen Wolf of Wall Street. It was, the brokers in New York City, cold calling people and trying to sell them stocks that, their firm just happened to be the one that's taking the company public, right? And there really wasn't a lot of choice. There was a small, mighty portion of the industry, right? Similar to your firm, what you all do at Vestia, that was doing financial planning and fee-based advice pretty early on, but we'll get to that. So if you kind of like fast forward a little bit, it went from, okay, so I'm now selling stocks. That's the job of a financial advisor, to, I call it the era of the mutual fund manager, if you will. And so that's kind of like, instead of me buying all the stocks, I'm going to buy a mutual fund and we're going to have this star manager, right? Maybe you remember Peter Lynch and the Magellan Fund at Fidelity and things like that, where it's, that was largely investing, but it was still, from the advisor perspective, it was still very much selling an investment product. The service that was being provided to the client was very much investment returns, right? It's like you are paying the advisor and they're giving you investment returns. So then this interesting thing happened. And I think, some of the parallels with medicine too, right? With technology, like you just see so much technology has come in over the past 20 years. Well, our industry is no different. And so what happened is E-Trade, right? Everyone remembers E-Trade and all the online brokers. You could then go on and buy them yourself. And so we had the day trader era, right? And then that kind of fell apart in the early 2000s. And there was just this tremendous period of change over that 10-year period leading up to and then accelerating after the financial crisis of 2009. And what we saw happen is the compensation model of the advisor, right? Like from our perspective of being practitioners in this business really changed, and it became what we call fee-based. Instead of selling you a product, right, Lauren and Forrest, instead of you going out to your clients and saying, I'm going to sell you a stock, I'm going to sell you a mutual fund, or you're going to log in and do, buy one of those things yourself. I'm going to sell you advice. And so all of that is to say the definition of advice really broadened over that period of time. And so we look at it today and we'll talk a little bit today, right, about our concept Advisors Alpha, but it's really kind of mirrored that change. And it's saying, advice today, what your clients are buying from you is not just investment returns. And it's this broad recognition that investment returns are just a means to an end. They're not the end in and of itself. And what you're selling, if you will, right, the service that you are providing is helping your clients meet their goals, helping them protect their assets, helping them with all these different things that we'll talk about.
I love kind of that level set, because I know I came in kind of right on the precipice of like right after the financial crisis started in the industry. And so there were still remnants of the commission, mutual fund purchases, that sort of thing. But the industry was changing to where now, most of the time when doctors come to us, they already know what they need in a portfolio. So they know, like, we need something that's diversified, we need some different stuff, we need low fees, we need to rebalance. Like, that concept is pretty well ingrained in a lot of doctors that we talk with. It's this idea of, I could go online and maybe try to implement that myself, or have a robo type solution do it for me. Or I could actually pay for advice in addition to the investment selection and investment management. And where do I end up having, hopefully, a better outcome? And how do I kind of make that decision? So I guess before we talk about Advisors Alpha, where did, like, this idea of alpha, Forrest and I understand, you understand, because that's an investment. I mean, that's something that you learn how to calculate when you're getting these, getting investment designations and things like that. What is alpha at the very base?
Yeah, at the very basic level, let's think of it this way. If you're buying an investment fund, let's just say, everyone knows S&P 500, right? It's roughly the 500 biggest stocks. An active manager, so if you hire a fund that's actively managed, their goal is to get a higher return than that of the S&P 500.
Mm-hmm.
So your benchmark is the S&P 500. The alpha is just the difference. It's, hey, let's say the S&P 500 did 10% last year, but your mutual fund manager got 12%. So you have 2% of alpha.
Yeah, like outperformance compared to a benchmark would be this concept of alpha. So then you all in your research have taken it one step further, where you're not just comparing, well, here's my portfolio return and here's the benchmark. You're actually adding other things in to determine this Advisors Alpha. So help us understand, what are the concepts of Advisors Alpha?
That's right. Well put. And I'll start with this. I always like to start with the laundry list of caveats, right? We're really proud of this concept, and it's very much evidence driven, but there's a really healthy dose of art to this. Mm-hmm. It's kind of like the marrying of the art and the science. And so if we think about that example of the S&P 500 being the benchmark and your investment return being the alpha, well, let's redefine what that benchmark is. And you can do that a number of ways. You can do that quantitatively, you can do it qualitatively, but we'll kind of combine them into a composite of what would things be without you? Like, where would your clients be without you? What would their investment returns be? What would their taxes be? What would their decision-making have been? What would they have achieved their goals? Would their goals have been as robust as they are with you versus without? Like, what would things have been if they had a different advisor that was doing, a different type of advice, right? Like, what would it have been if their advisor was a stockbroker or a mutual fund salesperson instead of a holistic financial planner? And so at its base level, that's Advisors Alpha. It's saying, okay, look, Lauren and Forrest, you come work with Vestia. Here's what's going to happen for you, right? Or look back, maybe you're a longtime client, and it's like, here's what we've helped you achieve. And it's trying to kind of measure those things. And so again, like, you can take that in a lot of different ways. There's certainly a large qualitative and like art, emotional component to it. But, knowing this audience, right, like quantitatively driven, I would kind of decompose it at the highest level in terms of numerically into three categories. And it's almost like looking at the leakage. And so what I mean by that is if you look at gross returns, versus net returns. And what do we mean? It's okay, well, your portfolio, let's say you're, a 70-30 investor, you probably got, most recent calendar year end 2024, I don't know, call it like 15% or so of a portfolio return. Well, the average investor that gets 15% on paper, they don't take home 15% because there's three sources of leakage. One is fees. So they're paying fees for the underlying investments. They're paying fees for the advice. The other one, a biggie here, taxes. All right. You're paying taxes whether you sell or not. Like there's capital gains taxes, there's, liquidation taxes, there's all different angles here. And that's whether you're accumulating, whether you're spending down, there's leakage from tax. And then the third one and the biggie, and this is where I tend to spend most of my time focusing. And I think it's the one that's not like the others, and it's much more of an art. It's behavior. There's this concept that we look at as researchers called the investor behavior gap. And what it is like I described, if you got 15% on paper, you could say like, well, let's look at the fund level. Let's just say pick a mutual fund, right? Or a category of mutual funds. You could say, well, this fund or this category got 15%. But if you actually look at the timing of the flows throughout the year, right? Like not every dollar of it was in it, January 1st, and not every dollar that was there January 1st remained at the end of the year. Money's coming in and out. And if you actually do kind of a time weighted, we call it average of that number is usually a good bit lower, probably by several hundred basis points in most categories in most years.
Yeah, which is so this is why I was so excited that Forrest wanted to join this episode today, because I know I've learned a lot from Forrest in this arena, and those who have been listening for a long time remember Forrest and I talked a lot about kind of behavioral psychological components of money, really, when we talked about like Forrest's story into coming up and being an advisor after being a psychology major, I think, right, Forrest?
Mm-hmm. One of the key things, and so our behavioral coaching, we call it, right, the behavioral psychology kind of research is built on, I would actually say, probably maybe a counterintuitive foundation, and something that's maybe not widely, I guess what I'm saying, like if I tell you what I'm going to tell you to an academic researcher on behavioral finance, they probably disagree with it, right? And they say, people are biased. People aren't smart enough to do this on their own, right? People are flawed, right? They make mistakes, and you always hear these negative phrases thrown around, especially in investing, like, they're shooting themselves in the foot, and investors are their own worst enemies, and all of these things. And it really comes down to irrationality. And, modern economics has really come to the conclusion that the average person, the average investor is irrational. Certainly, if you ask your clients about that, I'd say your clients probably more than most are firmly grounded in rationality and evidence and science, right? And so our kind of like key phrase we use is right mindset, wrong market. And what we mean by that is like the right mindset is looking at the evidence and making decisions based off of that. And so actually in our paper, we have a paper called Right Mindset, Wrong Market. And Lauren, you and I have kind of talked about this. There's literally a chart that shows mortality and morbidity outcomes by picking your surgeon based on ranking systems, peer review, and other markers of skill. There's this huge body of research around there. Like, and it's so obvious to us. It's like, if you pick a highly skilled surgeon, it's going to have lower mortality and lower morbidity outcomes. Obviously, that's basically life or death. If you go on Amazon.com and buy some little trinket that's completely inconsequential for $7, I don't know about you, but I spend like 2 hours reading every single review. And I'm like, why is this one 4.7 versus 4.5? And I'm like, 3.9, I'm not touching that, right? What is that? That's past performance. Of course, we're using that to make decisions everywhere else. And so then you look and say, okay, well, and we've looked at this across all these different realms of decision-making, right? Restaurants. We have a chart in there showing Michelin stars versus Yelp reviews. And it's like, if you pick a restaurant based on Michelin stars, what you find is that the Yelp review, so it's basically like the past performance versus your outcome that you receive, the Yelp review is higher on average for more Michelin stars, right? And much higher for anything that has a Michelin star versus that don't. Not only that, the dispersion is really tight. Meaning like you pick a 3-star Michelin restaurant, the Yelp reviews, it's like 5. Across the board. There's very little variance. All right, I could go on and on. Consumer News and World Report, college rankings, same thing. And on top of all of that, these things don't change very often. Like the best surgeon in your field today is probably going to be one of the top surgeons in 5 years, right? The skills don't decay because the ones that are the best tend to invest in their craft and get even better over time. The best colleges tend to be the best colleges. And so, what are you getting at, Mike, right? Well,
I'm waiting for you to burst the bubble and tell me why this isn't going to work in investing, because I feel like that's where we're going.
Well, the thing is, it doesn't work in investing. We know that, right? But if I build up this foundational case here and then say, but if you use that decision-making process that literally works everywhere else in life, except for investing, if you use that decision-making process in the investment world, you're irrational, you're making a mistake, you're not following the evidence and all of these things, right? Like that's kind of like the conventional wisdom on behavioral psychology today. And we just think that's totally wrong. And so we said the people aren't the problem. It's not your clients. It's not for lack of trying. It's certainly not for lack of intelligence or resources, experience, any of these things. It's the market that's the problem, because the markets are weird. All right. That's one way to put it. But it's, time period dependency and bad data. And, there's all kinds of, paradoxes that go on with investment returns and past performance. Other example for you, my wife and I recently just had our first child, and we were talking to our pediatrician, and he's getting ready to have his first child as well with his wife. And he's like, I need to find a pediatrician. We're just like, why don't you just treat your own kids? He's like, that's, you can't really do that. And so, same thing. Like we can sit here and talk about this all day. I can write papers on this and I still can't do it on my own.
That's so funny, because I purposely picked a pediatrician she's a mom of 5, because I was like, I feel like if you're a mom with 5 kids, like there's nothing you haven't seen.
Yeah.
That was actually a good decision-making point, right? I mean, that goes to what do you look for in a physician? And so it might not just be how they're board certified. It might not just be how long they've been out of residency or fellowship, what institution they're at. You're talking about something that is very much in the art realm that Mike was just referencing, right? You went to something that is absolutely not quantifiable, that somehow this pediatrician is better at being a pediatrician because she's a mom of 5, right?
She's amazing. So
that's actually irrational. Right?
Yeah.
And so if you think about our decision making, right? And I think about this for myself, and Lauren and I have many conversations about this. Our partners, we've all had many conversations about how we can coach others. And we are very good at coaching each other, at coaching our team members, at coaching our clients. But when it comes to ourselves, we have a difficult time seeing our own gaps, and we have a difficult time seeing how we're perceived, et cetera, right? And so I think that inability that we have in our own day-to-day work is something that people experience in all areas of their life. And so to me, the thing that I've always found fascinating about this particular paper that you were talking about is the idea of behavioral coaching. And behavioral coaching is really, I think, foundational to what we do, and why we're so good at what we do is because we approach every client first as a financial planning client. And we even call it collaborate, because we don't just think of it as financial planning. There's a bunch of different things that go into it. Like, what are your values, right? Like, what really matters to you? And then, it progresses through a series of meetings when we first get to know someone. That behavior, right, that people talk about in their comfort level with risk, in how they feel about different things, it all ties back as well to investments and how they perceive money based on their experience of family or other people that they looked up to. And so there's so much of all of this that's tied up in irrational and rational human behavior. So I guess what I would ask you, Mike, is when you look at behavioral coaching, what are the positive outcomes that Vanguard has seen sort of writ large? Like, are there categories?
Yeah. And before I answer that, I have to point out something you just said really resonated with me. And it's something I talk a lot with advisors all across the different spectrum of experience. You said the word values, and I hear a lot, and this kind of goes back to the history of the advice industry, right? So I've been doing this particular role working on Advisors Alpha for 15 years now. And I remember 15 years ago, it was like, hey, I'm an advisor. I want to become a goals-based financial advisor and, do the Advisors Alpha. And it's like, that's great. But over the years, I've come to realize like goals, it's still not about the goal. Like you could say, hey, my goal is to retire. And that still doesn't get at the true meaning of what you're doing and what you're helping your clients achieve. What you're helping them achieve is the underlying value. Great. You want to retire. Why? Like what's your perfect day in retirement look like? It's like, oh, well, I have the house on the beach where my family gets to gather and I'm finally going to have time to have, 3 generations of family come together for, a couple weeks every summer or whatever it is. And it's like that value there is time with your family. Or maybe it's, I don't love my profession, or maybe it's for medicine. I don't love working for a big corporate practice. I want to go private or a subscription model or something. So the reason that ties to behavioral coaching is because tactically speaking, we counsel advisors all the time to like, I use the term focus on the percentages that your clients care about. And what I mean by that is like, let's say we're in the throes of a market volatility event, market's down, 15 or 20%. Most investors, no matter how experienced you are, no matter how intelligent you are, what are they going to do? They're going to extrapolate that out to something else. They're going to say, well, my portfolio's down 20%. Therefore, that beach house where my family's going to gather, 20% less for that. Or I have to work 20% longer. Or I have 20% less independence. And it's like, that's not actually what happens there. And so as an advisor, to put the attention back on their why, their underlying value, is absolutely critical. And again, it's just something that like we are not mentally capable of doing ourselves. Any of us, no matter how experienced we are at this or any other industry, like in the throes of a high stakes moment like that, we're not capable of like reasoning out and managing our own emotions to get through that. So that's one. You asked like, what outcomes have we seen? Well, I'll give you like a really high level one. And I published an article on this last year. And so the way I'll explain it, we can look in aggregates, meaning like, let's take all clients, all the different investment funds at the whole entire industry level. And we can look at trends, right? And we can kind of see like, hey, well, if you did it the way that we think you should have done it, like what would have been? It's called creating a counterfactual. It's like, we don't have, on CNBC, right? It's telling you like this stock is this stock is this. And it's, every decision you make, you're like, it's in your face. Like you could have made this decision instead. And it's for all of history's sake there to measure. We don't have that for Advisors Alpha. There's no like benchmark. There's no ticker. There's no journal that says this is what would have happened had you not worked with Forrest and Lauren, right? Or your firm. But we can look at aggregates. And so we can say as a whole, like this is what investors are doing. And it's very simple. In the 1990s and the early 2000s, before the 2009 financial crisis, when we really saw this Advisors Alpha concept and the industry evolve to kind of align with that, investors chased performance. And so you saw as markets would go down, the average investor was underweight equity. And as markets went up, they were overweight equity. And so what would happen is they would miss the run-ups. And so they would be overexposed for when things would turn around. And that compounds itself. It's exponential in the sense of not only are you overweight equities when the market drops, you're too risky. And then you actually like bail out of the market too. So not only do you like lose too much because you don't have the right allocation, you actually have bad behavior on top of it, right? Or we should say suboptimal behavior. Anyway, since 2010, roughly, so the last 12 to 14 years, we've seen the opposite happen. And we largely attribute it. I think there's a lot of, as an evidence-based researcher, I don't know for sure. I can't sit here and look at, every single one of your clients have done, but we can look at the trends. And what we've seen is that the average investor has rebalanced and the average asset allocation across the whole entire industry has stayed roughly flat for almost 14 years. And it was tested during COVID, right? We had a really severe downturn during COVID. Now, devil's advocate, I could say it happened really fast. And maybe like if it was drawn out, maybe behavior wouldn't have been as good. I think it's because of advisors and kind of the shift to broad asset allocation and, portfolios that are more holistic in nature and an emphasis on goals and values. 2022 was a really rough year in the investment industry for all investors, especially those who were less aggressive portfolios. Like bond investors had one of the worst years ever. We saw people stay the course nonetheless. All of that is to say we were able to kind of like put very rule of thumb number on it of $500 billion in value that's been added due to better behavior over the last 15 years. That's incredible. Like that's now That's retail dollars of your clients and other clients and the industry as a whole. Like how many more goals are being achieved? How much more time are people spending with their family and all of these, great things that come along with that. I think a noble profession, right? Like what we're doing here, we're not saving lives like doctors, but we're helping people reach their goals and those things are happening. And that's the biggest change, right? We mentioned 25 years, we're putting out this paper and kind of looking back on what's changed. And that is the biggest thing that's changed is just the average experience is better. Things have been great for advisors. Our industry's been great. Like we're all doing really well, but our clients are doing even better. So it's just been a total win-win scenario.
I did not know that number, 500 billion. 500 billion. Wow.
It's amazing.
That is incredible. Mike, what I love about this paper is it's something that was really instilled in me right away at the beginning of my career in this industry, which is 25 years roughly.
A little bit longer ago than mine.
This a little bit longer. I'm a little bit older. But I always sort of knew gut. There was no real data, but I always knew gut that what we were doing for our clients was helping them, that it was helping them accomplish what they were trying to accomplish. But you rightly pointed out that it wasn't values based 25 years ago. That really didn't come up, at least certainly not mainstream, right? And I don't even think goals was mainstream at that point. So much was really commission based. I remember when I got my first check for doing actual financial planning work, right? Where I reviewed someone's portfolio.
You were in an environment where that was novel. Like you were like, I just got paid for my expertise. Like I just got paid to give advice. Yeah. And everyone around you was like, wait, what? Is that a thing that can be done? And now that's more mainstream than not. So you were very cutting edge in that.
Well, and I think that, I did have a psychology background and I just ate up every psychology course that I could possibly take. It's because I find people fascinating. And I also see how that manifests in myself, in my own irrational behavior at times, because let's face it, we all make irrational decisions. But one of the things that we talk with our clients about, and it's something that all of us talk to the newer team members coming up, is that, there are certain things that we can control. We can control how your portfolio is allocated. We can control, to some degree, fees, the internal costs of the investments themselves, the trading costs. We can, to some extent, control taxes by tax loss harvesting, perhaps in a non-qualified or taxable account. We can even project out potential tax savings by using a Roth versus a traditional IRA, or there's lots of different things that we can actually quantify. But I also always talk to my clients and we teach that we're not going to be able to pick a particular investment better than you. And we're also not going to be able to tell you when to buy or sell that investment, right? We know there's all kinds of research actually to the contrary, right? There was the old Wall Street Journal monkey study. I don't know if you're familiar with it. And then there's companies like yourself, like Dalbar, where it talks about market returns versus investor returns. What I do talk to my clients about is I say, but the one thing that you can always count on from us is that we're going to be the in between you and your investments and making a bad decision. And so it's that idea of you have to go through us and we can then reinforce why you did what you did.
If you put together what you and Mike are saying, what I love about this is not only is it stand between you and your investments and a bad decision, but I would also add like a bad decision for you. Because if you talk about the values, and we actually, this was 5 or so years ago, retooled our whole process for bringing on new clients, like for onboarding them. Because what we realized is over time working with someone, you got to understand their values and what's important to them. So you'd start with like, here are your resources, here are your goals. And then over time, you would build a relationship such that you'd start to understand that maybe there's not like a right decision in this case, but there is a right decision for this family based on what I know about what's important to them and the goals they're trying to achieve and the resources that they have. Because we're like, wait a minute, we should do that first. Like before we start looking at tax returns and investment statements and all that sort of thing, we should first get to the heart of what is important to you. Because you could look very similar to another physician on paper in terms of what kind of practice setting you're in, how much money you make, family size, where you live, all of that. And what's important to you could actually be very different. And us understanding that does make the difference between being able to say this is a good decision for you or this is a bad decision for you. And that might not be the same advice that we would give to someone else who has different underlying values. And so the first, I'll say like official meeting that we have with new clients at Vestia is what we call a values meeting. We have an exercise that we take that couple through where they actually rank order some priorities for us. We spend a lot of time, tell me what this means to you. Why is it so important to you? And we're actually trying to pick up all of those things. Then we set some goals. Then we put all of that together with their resources to build that plan. And then I would make the case, now this is not research backed, this is just like anecdotal, my perspective, listening to this conversation. We have focused our firm, like our clients are only physicians. And so having combined across our advisors 150 years of expertise giving physicians financial advice, seeing their contracts, seeing their pay structures, watching their practices be bought by private equity, all of these things, we can actually give them advice that some maybe other financial advisors wouldn't be able to give them, not because those advisors aren't great, but because those advisors do not have the exposure to the physician financial issues that we do and the network of other professionals that are able to support physicians where we know we need to be looking at this tax strategy for this situation. We need to structure this deal in this way because this is going to put the most money back in the doctor's pockets. And so I like to think that working with a firm that's specialized in you could actually maybe enhance that result of Advisors Alpha for your family.
Sounds inspiring. A really powerful model that you've built, but certainly the specialization is super important. And then, like, as I hear you talk, I'm thinking to myself, okay, well, like the evidence I know, like, Forrest, you mentioned tax loss harvesting, like we've saw that could be worth 150 basis points a year, especially for high net worth individuals.
Can you define a basis point for a doctor? Like, I didn't even know what a basis point was as a brand new advisor. So I'm sure we have a lot of listeners that don't know what that is in percentage.
100 basis points is 1%. So Vanguard research would show tax loss harvesting of 1.5%. And we would say tax efficiency in building a portfolio could be 0.6%. And for those drawing down, that's like another 1%. And so I'm thinking, okay, well, like you've built this incredible model. You have the network effect, right? And the power of connections and the specialized expertise that, by the way, only comes from experience. Like there's no book that you can learn of like, how do I manage, a client's financial situation for, a liquidity event? You have to go through it.
Mm-hmm.
By the way, just the stuff that you do on the tax side probably pays for your fee. It's like, that's when I look at advice and a lot of my role over the last 15 years, as crazy as this sounds, has basically been giving financial advisors permission to spend less of their time on investments. And you might think, well, that's weird. I work for an investment company. Why would we want people spending less time on investments? And you mentioned focusing on the things that are in your control. Well, in our Advisors Alpha research paper, there's actually a sketch in there from, I don't know if you know Carl Richards, who's the New York Times sketch guy.
Yeah.
It's literally in our paper. I email him every couple of years when we update it. And it's a Venn diagram. And it says things that are important and things that matter. And it says focus on here. And it's just, you almost have to build the evidence-based case that like, we went through with right mindset, wrong market conversation, right? Like more time, doing more research, coming up with more rating systems, digging deeper and deeper into past performance on investments does not lead to better returns. And so for an advisor, they're like, well, I'm getting paid to manage an investment portfolio. So I'm going to feel like I'm giving my clients a raw deal if I'm going to dial down the amount of due diligence I'm doing on the investment side. And it's not to say, like, I'm not saying don't do any due diligence, obviously. Yeah. Right. But like when I started doing this, we would say the average investor, the evidence would say, was spending 80% of their time, or average advisor was spending 80% of their time building investment portfolios. Right. And now it's closer to 20% of their time. It's actually less. The most recent data I saw from Cerulli was like 17% of the average advisor's time is on investments, and the rest of it's client facing, talking through values, thinking through behavior, doing all of these specialized niche little things for their client. We're still getting paid on investments for the most part as an industry. All right. Like Forrest, you mentioned getting your first check. When we published the first version of Advisors Alpha, it was only about 20% of the revenue of the industry was coming from fee-based advice. And now it's about 80%. It happened over the last 15 years really quickly. And again, correlated perfectly basically to that exact time frame of when behavior got better and decision-making got better, because advisors and most of the assets are advised. Like, we don't have great data on that, but our best estimate is that probably 80% or so of the assets out there are working with a financial advisor. Right? Wow. Certainly in the high net worth area. And so, advisor behavior has gotten better. All right. It wasn't just, and again, this just gets back to like, I'm sure all your clients are sky high IQ and, incredible work ethic and all those things. Those aren't the things that drive success towards, I call it actualizing your financial values. Right? Like being a good surgeon, being the greatest neurosurgeon or orthopedic surgeon in the world is not the same skill set at all of having a happy, fulfilling retirement surrounded by family and whatever else is important to you. And that can be a tough pill to swallow. But ultimately, I'm sure the clients that work with you stay with you for that reason, right? Like you're painting this vivid picture of what their life could be and what all the hard work's for and the long hours and the heartbreak and all those different things that they go through every day.
I don't know that I could have said that better. That's so true.
The humility, I think, that we see in the people who work with us it's fascinating to me because, you meet with a neurosurgeon or an ENT physician who they're training, if you do the 7 years, they're not working until they're in their mid to late 30s, right? Before they're in their first big paycheck. But what I think is so fascinating about it and what I love about our clients is they are incredibly intelligent people. And I think that they are so intelligent and so self-aware. One of the two top indicators of success for successful people is self-awareness. And so what these people are saying is they're coming to us and they're saying, listen, this is what I do. I'm a neurosurgeon. I'm an orthopedic surgeon. I'm a vascular surgeon, right? You name the specialty. I am not a planner. I have no education in money or taxes or RVUs versus collection-based models or how to read a contract. And they say, but I want to turn it over to you. And I just want to review with you periodically. And, it's a great honor, first of all, to have such intelligent people come to you. But what I found is that their behavior is so much different. And so it's interesting to hear you say that behavior has changed over that same time frame. Because I had no clients, none, zero. I don't know if you did, Lauren. I don't know what the firm number is. I've never asked. Pull money out when we entered the pandemic. And in fact, I think that my clients are so dialed in on how to approach investing that they were putting more money into the market during that time, right? And so it's really fascinating to me how much that education has changed the way that doctors approach not just investing, but financial planning, their whole financial life as a whole.
I think it's great evidence to the behavioral coaching piece of it, because when you say we didn't have clients pull money out, I certainly had a number of conversations with doctors who were fearful. And I think COVID was a very interesting time to be an investor as a doctor because they actually knew more than we did about what was going on in the pandemic. In fact, I was taking a lot of direction about how to make my personal decisions from clients of mine who were working in the ICU. And so them coming to me and saying, hey, here's what I'm seeing. Here's what I think might be driving this big downturn in the market. And I'm afraid because I know, like from a health perspective, like a public health perspective, this is going to get worse before it gets better. Is the market going to be the same way? And so being able to have that conversation, disconnect from not saying that their experience wasn't very real. And I'm so thankful that they were doing the work that they were doing during that time. But being able to say, here's what we know about the markets. Here's what we know about how the markets behave. Here's what we know about looking at the long term versus right now. And that led to, in a lot of cases, exactly what you're saying, Forrest, which was, let's take some cash on the sidelines and take advantage of this sale in the market versus let's come from a position of fear and pull money out. And that alone could make a huge difference in those long-term outcomes. Because like you said, Mike, those decisions compound over time. So I think that's like a real-time example of where physicians benefit from that behavioral perspective of an advisor.
And we have this chart. I use it all the time. It's literally just, it's the return of the stock market from Jan 1 to December 31st, 2020. And it shows like, public health statistics and, kind of like media headlines along the way. And it was an interesting case study, like looking back with some distance now, obviously such a tragedy, just absolutely awful. But like, just from like an evidence perspective, there were so many lessons that came out of it. From a behavioral, coaching perspective, you often hear maybe some of those conversations that are like, hey, like I'm going to wait for the all clear signal and then I'm going to get back in. And so you never know what the all clear signal is. And we actually had replicated this we had a similar chart for the financial crisis where it actually showed, if you looked at like whatever the pre-crisis peak was, and then it bottomed out in March of 2009, the headline on the Wall Street Journal, we actually have a picture of the headline, was Dow 5,000. All right, here we are, I don't know, 40,000 or wherever we are, 45,000. Crazy. It said Dow 5,000, there's a case for it. That was the actual bottom of the market. And then we tracked and you saw like the economic data kept getting worse and worse and worse. And the headlines got worse and worse and worse. And by the time there was a whisper of positivity, the market was up 60% from the bottom. Same exact thing happened in 2020. Well, you never knew with y'all, right? Like people were bailing out of the market. Like our evidence showed like people were getting out of the market in 2009. And if you're saying, okay, well, I'll just wait for the all clear signal to get back in. Well, no one even knew what it was. I have a family member who's a mortgage banker. He's like, I'll get back in when the housing market recovers. So like COVID, but you could be sitting there in March of 2020 and say, I'm going to get back into the market when the vaccine's approved or when the pandemic's over or there's a cure, right? And so we actually track that on there. The day the FDA approved the first COVID vaccine, the market was up 19% on the year after having been down 30%. And so somebody who bailed out of the market, and again, it was so quick. So like, there's two sides of this coin. Like it was so quick that I think sometimes maybe people were thinking about bailing and they kind of missed the window and it started coming back and maybe got out, just a hypothesis. But also like to the extent you did bail out of the market, it was so fast and severe, you were probably close to the bottom. And so to put this into numbers, and this actually led to a tool. So we have a calculator on our website where you can put a start date, a stop date, and a bail to cash date, and like a get back invested. And we have pre-populated events going all the way back to 1960, and we update it every month. And it's interesting because it kind of creates that alternate history, right? We call it the market hindsight tool, but it always started as like the alternate history calculator. Hey, $1 million portfolio on January 1st, if they had bailed out of the market, they locked in at, call it 750K. If they had stayed invested by the end of that year, it would be at 1.25 million, right? And you fast forward today, you're looking at like 1.7 million. And by the way, if they had bailed into bonds or bailed into cash, I mean, bonds had a horrible year in 2022 and they're still not broken even, right? So like, that investor who could have a $2 million portfolio instead of $1 million today might still be locked in at $750,000 or $800,000 because of that one decision. Right. And that was somebody that like, and that's with the Forrest, you mentioned the Wall Street Journal study. There was another recent one where they I'm probably going to butcher the details here, but they basically did like a trading game where they gave you the headlines of the year and they gave you a certain amount of money and you can trade, and all the people lost all their money. So they knew the headlines, they knew what was going to happen in the world, and they still lost money. Right. So like if you just did that chart and I didn't tell you what the market returns were, you're like, oh, I'm getting the heck out of the market in February. Right. And I'll get back in December. Like that was the rational, logical thing to do, given the facts, but the opposite happened. And in retrospect, we're like, well, the Fed came in and the government did, but like, you guys remember how that was crazy at the time. Like I started my career early during the financial crisis. I remember being on the equity trading floor when Congress voted down the bailout plan, and the Dow dropped 1,000 points, but it had started at like 7,000 that day, right? Like the Dow drops 1,000 points now from 40,000, and we're like, whatever. But I watched it drop 1,000 from a starting place of 8.
Big difference.
Yeah, big difference.
Yeah. I heard it said once, and this has always kind of stuck with me because I've seen this play out when I've talked with maybe prospective clients who made some of those decisions. And then they're like, I don't actually, like, now I don't know how to get back in. And that's part of why they're looking for help. You trade the uncertainty of like, you get out and you're like, okay, like I like can breathe easy. And then all of a sudden, like that anxiety reappears on when you get back in. So we talk about this concept at Vestia. I'm putting you a little bit on the spot here, Mike, but you've alluded to it so many times as we've gone through. I'm interested to hear your answer. So our mission is to help the highest caliber physicians achieve wealth that matters. And so we're not saying that we're looking for that top dollar number, like just collect it to collect it, grow it to grow it. It has to be for something. And ultimately, both now as you're accumulating and later when you're withdrawing, we want you living wealth that matters. So I'm curious for you, Mike, and everything that you know and everything that you can think about with investors and behavior and advisors and all of that, what would you say wealth that matters means to you?
No, I was wondering where you're going with this question. I love it. And again, this has been just an amazing conversation because we're so aligned on like how we think in terms of the values. But I would look at it from the individual perspective. Like to me, it's probably something completely different. That said, I think it's probably for most people, there's a couple buckets, right? And it's like living well today, making sure your family is taken care of. I think most people at any level of wealth are always going to be concerned about later in life, like whether it's just the cost of their care, not being a burden on their family, making sure they're able to get the best care, those things. And then, I think everyone wants to be remembered as well. So the legacy is really important. And even if it's that 5 generations from now, no one's going to know who I am, but my family will be better off because of the hours that I'm putting in today than if I don't put them in. So to me, that's what I think matters most to people. It's usually going to be the family and safety. And, I don't buy into this whole vision of retirement of like, I'm going to buy the yacht and sail around the Caribbean, right? Like, I don't know if you've heard the concept FIRE, right? Like financially independent, retire early. It was kind of a hot thing a number of years ago. And now it's there are all these people that saved up like $1 million by the time they were 35 and retired, and they're all just completely without meaning.
Mike, that's funny that you said that because I joke with my partners because I'm older than a lot of my partners, and I have a subscription doctor, primary kind of meet with her every 6 months. She's amazing. And I asked her if she was going to be retiring soon because my previous doctor had retired, and she said, oh no. And she said, the most recent statistics around retirement and mortality, I will be working for decades to come. And she said, and knowing you should do the same.
Which is great because that means you're doing something meaningful. Like not everyone's sort of fortunate, right? Like
no.
Some people are working so that they can stop doing the job that they're doing and then find something else that's more meaningful.
Exactly.
It's probably not sitting on a beach drinking margaritas, although this sounds so nice right now. But that's a vacation, not several decades of life.
Yeah, no, that's
No, I love that. Well, thank you so much, Forrest, for hosting Mike with me today. It was great to have you here, especially to add some of those insights on the behavioral side, which I know you're so good at. And I learned so much of what I know in that realm from you. So that was quite the delight. And Mike, this conversation was amazing. Like I said, we could talk all evening. I could ask you so many questions, and I just really appreciate you giving your time, which I know is really valuable, to share a lot of these thoughts and insights with our audience. I know that these perspectives are really going to help doctors when they're thinking about what matters and when they're looking for maybe some kind of evidence research-based way to justify the decision that they're making, investing in having a financial advisor and feeling really confident that that's a great decision for their family. So I appreciate your insights. Thank you so much, all of you, for listening. Again, I'm Lauren Oschman. Please do follow and subscribe to the show so you don't miss any of our amazing episodes that we have coming up. And we'll see you next time.
Thank you for listening to the Doctor's Eyes Only podcast. We hope today's conversation advanced your journey toward wealth that matters. Make sure to follow and subscribe so you don't miss a single one of our amazing episodes. Thanks so much, and we'll see you next time.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Vestia Advisors, LLC. The content has been made available for informational and educational purposes only. It should not be construed as legal or tax advice and is not intended to replace the advice of a qualified attorney or tax advisor. This information is not an offer or a solicitation to buy or sell securities. Investing involves risk, including risk of loss. Before investing, you should consider the investment objectives, risks, charges, and expenses associated with investment products. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. Past performance is no guarantee of future results. Diversification and asset allocation do not ensure a profit or guarantee against loss. Consult your financial professional before making any investments. Investment advisory services offered through Vestia Personal Wealth Advisors, Vestia Retirement Plan Consultants, and Vestia Advisors, LLC. Securities offered through Osdale Financial Partners, Inc., 5187 Utica Ridge Road, Davenport, Iowa, 52807. Member, FINRA, SIPC. Vestia Personal Wealth Advisors, Vestia Retirement Plan Consultants, Vestia Advisors, LLC, and Osdale Financial Partners, Inc. are independently owned and operated.